All right. Well, sorry to get started just a couple minutes late, but thanks again, everyone, for joining our webinar. This is a webinar hosted by the Economic Innovation Group and part of our series on opportunity zones. We will be focusing today on impact investing in opportunity zones and providing some examples, recent examples of investments across the country where this has taken place. So my name is Catherine Lyons. I'm the manager of policy and coalitions for the Economic Innovation Group. I'm joined with my colleagues, Rachel Riley and Kenan Fikri. Just a couple of housekeeping notes here at the top. This is being recorded. We will share a copy of this recording and the slides, as well as a blog post recapping this discussion within the week. So you will see that in your inbox since you are a registrant within a week of this webinar recording. Everyone is muted, and the way to ask questions, which we certainly welcome, would be best through the Q&A. You can use the chat to kind of chat with others currently in the webinar, but the Q&A is the best way for us to monitor any questions you have on anything that we're discussing over the course of the presentation. So please feel free to use that, and we will get to the Q&A at the end of the webinar. I believe that's it. So I will turn it over to Rachel to kick us off.
Thanks so much, Catherine. And as Catherine mentioned, today's title for this webinar is Impact Investing in Opportunity Zones. And really to provide some framing, we are really privileged at Economic Innovation Group to have insights on activities that are happening throughout the nation. We place those in two areas, one on our OZ activity map, really encourage folks to check it out, as well as a new resource on our webpage called Initiatives and Investments. So today what we're going to do is, number one, we're going to go over the White House Council of Economic Advisors report, which provides an initial assessment of opportunity zones that came out on Monday. And so that's somewhat of late breaking news. But then we really wanted to, I guess, pop the hood on that report because the report provides high level numbers, some economic projections, but we wanted to provide what we're seeing in the market. So we're going to provide a market snapshot for folks. We're also going to talk about some investments that are creating an impact, and we've bucketed these by a number of different themes. And so we hope that, number one, it elevates the great work that's happening throughout the nation, but also it gives some inspiration and some models for folks on the phone and who watch the webinar at a later date to replicate and scale, because we think that these models are really important ones. They're showing how opportunity zones is creating impact in communities and for residents and businesses. And then we're going to hop over to Q&A. We've already got a few questions that were submitted prior to the webinar, so we'll try our best to get to those. But please, as Catherine mentioned, submit questions throughout. And then, of course, at the end, we're going to wrap up with some Opportunity Zones resources, including some new ones that were just put out by the Milken Institute as well as OCC. And with that, I'll turn it over to Kenan.
Hi, thank you, Rachel. I'll come on screen. I'm Kenan Fikri, the research director here at EIG, and happy to tell you some of the highlights from the Council of Economic Advisors initial assessment on opportunity zones impacts for the first about 2.5 years of the policy's existence. I think right off the bat, it's important to state that this was clearly a technocratic exercise from staff economists. That represents a real genuine attempt to take stock of where we are and what we can say and project off of what we know so far. So of course, many of us have seen the campaign pick up the findings and run with it. I think that's to some extent to be expected, but the underlying document itself is kind of standard academic production here, not really as political a document as it's necessarily being used for in communications. It includes some really good statistics about OZs, including the nature of the places that were designated as opportunity zones. A lot of people have seen a number of statistics on this front, but they have some great data visualizations and some novel insights kind of on the map itself and how OZs differ from non-OZs in comparable communities. And then they include some models of projected economic and budgetary impacts based on what we know has been raised so far. And what has been raised so far is a substantial pot of money, $75 billion in private capital raised by the end of 2019. that is much larger than many of the other numbers that you're probably used to seeing cited in the news or in other presentations. The best available other estimates come from Novogradac and Company, but even they're very forward that they're only looking at a segment of the opportunity zones marketplace with their estimates of 10 to 14 billion raised so far, just a small window of the marketplace, and that they project multiples higher investment dollars is the true scale of the market than what comes across their platform. And this CEA data that taps into Novogradac's resources, taps into SEC filings, and some other proprietary treasury data arrives at this 75 billion number, which smells right to us based on what we know on the market too. I think this is more money raised at this stage than people initially expected, which is great news. So of that, they break out kind of how much is new, how much would have happened anyway, and how much was shifted from other parts of the country. And you can see the figures there. So just over 52, I think 52 billion, we would call kind of the new investment, at least new to opportunity zones, in that it was either kind of induced from the incentive itself, wouldn't have come without the incentive, or it would have located outside of opportunity zones, and because of the incentive is located inside opportunity zones. From the perspective of those who crafted the policy, both are successes, including the money that got shifted because one of the underlying theses of opportunity zones is, of course, that over time, kind of location decisions have real impacts, and for the places on the wrong side of successive private location decisions going back decades, they're suffering from systemic disinvestment. So if we're changing the margins at the margins of where capital chooses to place its money and try to invest in revitalization, that's a policy success. And then about 23 billion would have, quote unquote, happened anyway. So this is kind of what you get with all tax policies, right? If you're talking about R&D and the R&D tax credit, and who would have done R&D without it, there's a good chunk of that. Earned income tax credit, who would have worked without the EITC, there's a large number of people who would have done that. Similarly, who would have invested in struggling opportunity zones without the OZ incentive? The answer that they credibly come up with is about 22.8 billion out of the 75 would have happened there. This represents about just over 1/5 of total total annual investment taking place in opportunity zones, which means OZs, at least kind of market wide, looks like it's opened up a really substantial pool of investment capital for these places, relative to what they were seeing before. And they calculate that private equity investment in OZ businesses based on SEC filings grew 29% relative to a peer group of tracks that were not OZs. And they adopt some methods from a study in 2012 that looked at the anti-poverty effect of the new markets tax credit, apply that to the amount of money raised through OZs, and calculate that so far the money raised could lift up to 1 million people out of poverty in opportunity zones over the lifetime of the policy. That itself, and this is maybe the most political aspect of the report, but that itself, they say, as people get weaned off transfer payments and other modes of public policy support, could help OZs be budget revenue neutral for the federal budget by the end of the window. So we will see what transpires. I think from our perspective, one of the biggest questions is whether the assumption that OZ projects have the same anti-poverty effect as NMTC projects did actually pans out, and you can kind of use the same models and projections based on that, or whether OZ projects and investments are fundamentally different from that policy. And then we've seen a couple studies before this come out that try to estimate difference in home prices and asset prices in opportunity zones since enactment. This report is in line, or it updates some of those and finds a 1.1% increase in home values across OZs, which may sound small, but that actually translates into $11 billion in new housing wealth for residents of OZs who own their own homes, which is a real, actual substantial transfer of wealth. So that's I think points to an early success that this has indeed helped rekindle market activity in these places to the benefit of long-term owners in them. And then consistent with what we would expect, given kind of what we know about the stage of the OZ marketplace, there have been more significant price impacts on the on redevelopment properties and vacant properties, which are especially attractive to OZ investors given the timing considerations and other aspects of the rules and regulations that make them especially favorable. But we've seen almost a 20% increase in the price of vacant properties. This means, this is actually really good for infill development in neighborhoods, for kind of completing the fabric of neighborhoods, for refurbishing old properties, and even for, over the long term, helping boost municipal tax bases by taking something that was economically inert and turning it into something that's economically productive. So these are, I think that the report at the end of the day gives us a lot of reasons to be optimistic, but Catherine, next slide, please. It also gives us, or maybe, thank you. It also, to us, reiterates the need to complete the unfinished business, because the promise is there, but to ensure that it delivers, we need reporting requirements. We need to know more about what sort of investment is taking place, and really critically, we need to know where it's happening. That's the big kind of missing piece and omission from the CEA report, and the blind spot right now. We have no idea really how many OZs are actually seeing investment, how much they're seeing, how diverse are the sources of that investment. All that's unknown, and it will be really hard pressed to come up with credible estimates of the true impact of this if we don't know the places that are actually seeing benefits and direct investment from it. So our EIG's press release around the report also called for sunsetting some high-income census tracts that really shouldn't be opportunity zones, but came in through quirks of the qualification criteria. This is really essential for kind of maintaining the integrity of the map on which the first stage of the policy is playing out. Should also provide additional technical support and capacity building assistance for communities. Communities have their own learning curve to go through here, let alone investors and project sponsors who are trying to figure out how they can make OZs work for them. And especially given the pandemic and what it's done to state and municipal finances, some extra resources could go a long way here. And then also, given how slow the regulations were to be written, and now the shock delivered to the market by the pandemic, we're advocating for extending the 2026 tax deadlines by 2 years to allow the kind of fully baked market to form here for the time ahead. So with that, I will pass it back to one of my colleagues.
Wait, that's me. Thanks. Thanks, Kenan. So the next phase of the agenda will be more focused on the kind of a market snapshot. And a lot of these trends that we're gathering here, in addition to the survey that EIG did back in late May, early June, which is on our website, and I encourage you to take a look at that for a snapshot in time of how the pandemic was affecting the early phase of the pandemic was affecting OZ activity. This is also from our partners at NES Financial, which is a firm that works with dozens of opportunity funds, primarily on kind of compliance issues. But because of their exposure to so many funds, they get a real set of insights into the market and where it's trending. So we wanted to share with you their summer 2020 OZ data insights from their work. And essentially what we're seeing here is an increased focus on operating businesses. In the first couple of years of the market, opportunity zones certainly trended much heavier toward real estate. And you'll see here that that's still the case in terms of the asset types that are receiving investment, primarily housing being the predominant asset type here that that has dominated the market. But because of the final regulations, which came out in December 2019, and just some increased clarity, I think, as the market continues to develop and norms continue to develop along with it, we are seeing an increased focus of funds on operating businesses, which is great to see. From our perspective, this was always one of the core intentions of the incentive, and Congress has also said the same, was to not only improve the built environment, but also to help seed and fund entrepreneurs and new businesses and existing businesses that are looking to expand in opportunity zones across the country. So we are starting to see the trend line show that that's coming to fruition. And we'll get into a little bit more on examples of recent investments in operating businesses in just a few minutes. We're also starting to see more multi-asset funds. Again, with the kind of slow start to the regulations, we were seeing much more single asset funds initially. They were easier to structure, much more straightforward with the guidance that was currently available, and also worked well for real estate. But now we are starting to see more multi-asset funds. And again, I think that's part of the clarity that was received from the regulations. We're also starting to see that the target fund size is trending downward. This may be because more funds are entering into the market. But if you look at and this is all linked on the slides that will circulate after the webinar, but if you go into the data insights a little bit more, you'll see that most of the funds, at least more recently, that have formed are aiming at more of a 50 million or less raise, whereas previously they were more in the 100 million kind of range. So we're seeing target fund sizes decrease a bit, and again, that may be because of market competition or just what the market is currently demanding. And again, as mentioned earlier, housing still is the dominant investment activity, mostly multifamily, in many cases market rate, but also a significant chunk of that multifamily housing is affordable as well. Interestingly, we're seeing more of an increase also in renewable energy projects. So you see there in Q1 of 2020 that energy is taking up more, and actually Q4 of 2019 as well, that energy is taking up more space there in that bar chart. And that tracks with some of the anecdotes that we've been hearing across the market as well. I also wanted to reiterate too the bipartisan support that has continued to grow for opportunity zones. One of the most notable kind of news lately, at least, was Vice President Biden, recognizing and including opportunity zones as part of his Build Back Better plan. And for racial equity, and modifying opportunity zones and improving them in ways that in many cases we align with. For example, the need for additional reporting requirements. They also are interested in having Treasury take a look further at the program to ensure that it is meeting its intended goals. Another example of where they're looking for reforms is putting community benefit agreements around some of the investments. So regardless of kind of some of those specifics, we were encouraged to see that the Biden campaign was including opportunity zones as a tool for advancing racial equity and part of that overall plan, with some modifications that we, on the whole, kind of directionally agree with. As Ken had mentioned earlier, and we've been pretty vocal about our support for the need for some improvements to the incentive. So anyway, just wanted to point that out since that's relatively recent news, and certainly a plan that was talked about at length during the Democratic convention last week. We'll also see that there's a host of governors that have maintained or reiterated their support for opportunity zones, and some of these, for example, Governor Polis wasn't around during the actual designation process and came in afterward, but has still maintained and really embraced opportunity zones within the state, and put together quite a few policies to help local capacity building and investments in particularly some of the more rural parts of Colorado, and they've really started to see that work pay off as well. In Maryland, they've been early leaders in opportunity zones, layering on additional incentives and putting some real thoughtful state policies in place to encourage investments in businesses and real estate across the state. So see here that Governor Hogan's support there. And finally, State Representative Pendarvis from the state of South Carolina recently penned an op-ed in the Post-Courier about North Charleston, which is a very distressed community in the state, about opportunity zones and how he sees it as a tool to improve neighborhoods without displacing current residents, and really hopefully benefiting current residents and offering new economic opportunities. So opportunity zones has always been a bipartisan piece of legislation dating back from its inception, and we're encouraged to continue seeing some of that bipartisan play out, particularly at the local level, but also in some of the national conversations as well. So I will turn it over to Rachel now to start leading us through some of the examples that we're seeing across the country.
Thank you, Catherine. And thanks, Kenan, for the overview of the CEA report. Really appreciate the distillation on the different findings there. So to begin talking about impact themes, what we do know is that new ecosystems of community development intermediaries have emerged to implement local opportunity zone strategies, and that a new set of stakeholders that were previously not engaged in community economic development have been activated through the policy. As a result of that local activation, opportunity zones is yielding investment in a wide range of activities in communities of every size across the country. And so to a question that was asked earlier, when we're talking about impact investing, we're not necessarily putting a definition on that. In fact, there's many definitions depending on, it's in the eye of the beholder, as some might say, but what we're seeing is opportunity zone investments going to support activities whose anticipated outcomes will indeed either strengthen communities or benefit local residents and businesses, or both, and most likely both. And so the different areas of impact that we're really seeing some concentrated areas. The first is creating affordable and workforce housing, supporting small businesses and entrepreneurship, seeding neighborhood revitalization, driving innovation, improving health outcomes, revitalizing rural communities. And we're seeing opportunity zone strategies and investments come to fruition where anchor institutions are partners. So anchor institutions being local universities, colleges, incubators, as well as faith-based institutions and major employers. And we're also seeing the local government start to partner with opportunity funds. I think I've mentioned this example before, but one of my favorites is where RevOZ in San Bernardino County in California did a build-to-suit financing and development of a property that will then be leased by San Bernardino County. And I think that that is a really great model, especially as we go into, both the recovery effort for the pandemic, and we understand how local governments may be strapped or their budgets may be in some ways diminished, how opportunity funds can be working alongside government for a mutually beneficial outcome. Next slide. So on the point of creating affordable and workforce housing, as Catherine mentioned, housing is a big part of the market right now. And so we have two examples here, recent examples, and a lot of the examples that we'll be providing today are relatively recent. So those that were either announced or have broken ground in the past couple months. And so that's also meant to demonstrate that activity continues to happen. But going back to affordable and workforce housing, this first one that I want to share is a recent announcement from Miami, which folks may well know is a very high cost city with a lot of needs around affordable housing. And there are two new projects that have broken ground in Miami. They'll create 635 new homes. The first project is a 263 unit renovation of public housing. So I said new homes, but 635 homes in general. This renovation is obviously supporting existing public housing. And in addition, that project will also deliver 120 new apartments as well. This was a $24 million OZ investment, and the capital stack was also supported by the low-income housing tax credit, rental assistance demonstration program, Home Dollars, so that's a program from HUD, as well as a program from the city called the Purchase Money Mortgage. So just to provide an example of different models for leveraging multiple sources of financing in order to actually activate the opportunity zone capital in these types of projects. And then the second project in Miami is a mixed use project. It'll include office and retail space, as well as 252 affordable homes that will be affordable to residents earning between 60% and 140% AMI. So once you get over that 60% into the 80% range of AMI, you really are talking about workforce housing in a lot of circumstances. And then going to the other side of the spectrum in Lexington, Kentucky, this is a really great story. And I had the opportunity to talk with Nest Opportunity Fund a few weeks ago. And they shared a few things with me that they're written here, but also I'll share as I'm speaking. But this is a family-run opportunity fund. The family sold a portion of their business and then invested the capital gains to create a fund. They're also seeking additional investment from outside investors. And their real purpose is to revitalize dilapidated single-family homes in Lexington, Kentucky. They're working alongside the city to do that, as well as with local banks. And the whole plan is to provide these as rental units, but then allow some portion of the rent to be accrued as equity for the renters in the case that they want to purchase the home after year 10. And so we talk a lot about lease to own or lease to purchase, and this is a model that looks very similar to that. In addition to that, what I was really encouraged to hear and what I was hoping would be one result of the policy is that 10-year term, that long-term hold that investors are shooting for is actually encouraging a higher standard of construction. A lot of times when we talk about merchant developers where they will throw together a project really quickly and they don't have a long-term vested interest in the operations of that project or when things will need to be repaired. A lot of times the construction quality is not that great. And so as the opportunity zone policy and the benefits associated with it are encouraging longer term holds, the developers and the investors are thinking about ways in which to make nominal investment on the front end that'll help save them money in needed repairs and improvements over the term of that investment. That's Nest Opportunity Fund. And with that, I'll turn it back over to Catherine.
Sure. I think that's actually me.
Okay. Go ahead, Kenan.
Yeah, okay, thanks. Yeah, I'll take these two and then kick it over to Catherine. In Wilmington, Delaware, Second Chances Farms is a really inspiring story that is now, I think, on its second or expanded round of OZ financing, where the firm is creating a vertical hydroponic farm that looks to that's just the starting point to reinventing agriculture and the provision of fresh food in urban environments. They're also staffed by returning citizens in order to reduce recidivism from the criminal justice system. They are targeting the long-term unemployed and food insecurity in some really distressed neighborhoods there in Wilmington and corners of the interior eastern seaboard. So far they've hired 24 individuals and they've contracted with a local grocer to get their produce on the shelves. They have just been a great example of a firm with a mission that succeeded in attracting OZ capital now multiple times and is a burgeoning emerging success story. Then in Mesa, Arizona, two opportunity zones leaders and early movers. So Launchpad, based out of New Orleans, but with footprints all across the country. And the Caliber Companies, which is a predominantly real estate development firm out of the Phoenix area. They've teamed up to open a new incubator in a key district in Mesa, Arizona. And also Caliber is investing directly in Launchpad to help expand their operation and footprint and grow that company through an opportunity fund investment as well. So here we have kind of overlapping models that demonstrate the varied ways in which OZ capital, like in practice, can come hit the ground and help businesses grow and expand. The classic example is, of course, that direct equity stake in a startup business. But you can also, as Launchpad is doing, invest in space that the organization moves into. You can invest in build-to-suit properties, etc., and use OZ Capital in various ways to help a company grow that can go beyond that kind of classic case scenario. And on that front, actually, EIG will be producing two toolkits over the next couple months to help apply opportunity zones investing scenarios in different practical areas, thematic areas, and in different geographic areas, where we're looking forward to enumerating some of these kind of different economic development case studies of practically just how OZ investment meets the economy in different ways. Let's go do next slide. Then in Coatesville, Pennsylvania, the city itself has partnered with Activated Capital, a firm out of New York, to create and raise a $25 million fund to reinvest in the local community. This is, early days in the OZ marketplace. We heard rumblings of whether cities themselves would sponsor or wish to create their own or their designated or blessed opportunity funds to invest in the community and kind of be a flagship for raising and redeploying capital locally. And Coatesville is one of the neighborhoods that's furthest along that front. So this is a nice emerging fund model to watch their success and how they do from here. They're interested in building and intend to build a diversified fund that takes stakes in both businesses and in properties locally. And then in Cincinnati, Ohio, in the Over the Rhine neighborhood, they're really successful kind of downtown and downtown adjacent public-private partnership, 3CDC, the Cincinnati Center City Development Corporation, I believe. I'm from Cincinnati myself, so that's the only reason I know that, has embraced the Opportunity Zones incentive, which is exciting because the OZ kind of idea in many ways dovetails with the work that this organization was doing almost a decade prior to OZ's becoming, I think up to 15 years prior to OZ's becoming law, to try to revitalize some of the really core historic and predominantly minority neighborhoods in the shadow of downtown Cincinnati. And they've gone really big, and true to their super sophisticated form, they're combining all sorts of different streams of federal, local, and private capital and support to do that, with NMTC, LIHTC, and historic preservation tax credits to invest in dozens of properties for $51 million in total of infill development. For those of you who haven't been to the Over the Rhine neighborhood in Cincinnati, it's one that has indeed seen a lot of investment over the past decade, but it's a neighborhood that also has some of the highest vacancy rates that you'll find across the United States, a neighborhood that still has really systemic poverty issues and issues with worklessness and lack of access to opportunity, and a lot of infill development that it demonstrates, I think, the scale of capital that many of the hollowed out and historically disinvested neighborhoods across the United States can actually absorb right now. And here, 3CDC is a really respected steward that has inclusion and opportunity baked into its mission statement and model. They're working, or many of the units that are being constructed through this investment will be affordable to very low income folks, not just workforce housing. So it's a real model here that we're excited to see 3CDC embrace and see what happens, because I think it'll be powerful, and it's evidence of the scale that EIG, you've heard us always expect to see begin to take shape across the country, and this is one of the biggest ones yet, I think. So with that, I will hand it over back to Rachel.
I think this is actually mine.
I think we thought the ping pong between speakers was a good idea, and now we're rethinking it, but you'll get the content.
Great, thanks, Ken and Rachel. So the next is kind of this idea of kind of driving innovation and some of the investments that reflect that. So vertical farming is interestingly an emerging kind of asset class that has really fit particularly well with the Opportunity Zones incentive. Ken obviously mentioned Second Chance Farms in Wilmington. Braddock, Pennsylvania is also seeing a solar powered, fully automatic vertical farming operation called Fifth Season. You see they employ about 30 people here full-time and are hiring and growing. They've also recently contracted with local grocers to provide, again, that fresh produce, and I think have really seen an uptick in demand for their product since the pandemic as well. So we are, seeing here that there's employment opportunities as well for, a range of folks at a range of education levels here and working and also gaining really valuable skills of working alongside some of the robotics. There's actually I think a video of their operation, which is really fascinating to watch. It really is, completely fully automated, and it's pretty exciting to see the level of technology that is being kind of pioneered alongside, of course, the fundamental farming operation here as well. So another really interesting company to watch that is growing, with the help of Opportunity Zone investments. Another one in Chicago, and I think this is one is good. It's also particularly, kind of well suited, I think, for unfortunately our kind of current economic environment where there's a lot of job seekers and they are seeking, employment opportunities. So Verte Opportunity Zones, invested a while ago back in this new company. Startup technology company that helps connect some of those job seekers with a broad network of employment opportunities. They received this opportunity fund investment to expand their scope. So we're seeing here again, as we mentioned, there is increased numbers of or the kind of the pie or the share of the market is certainly increasing for operating businesses. These are just two examples of that, and certainly seeing here that there's also an opportunity for high growth kind of technology companies in some of these distressed communities to receive opportunity funds. These are two examples of that type of company receiving such investments that have really helped them grow and kind of meet growing needs, I think, in their communities as well. So another one is improving health outcomes. And I think this is just a really interesting kind of use case for Opportunity Zones. So a very recent announcement out of Philadelphia and the Tioga neighborhood, I believe, that is primarily, I think, a majority minority neighborhood, has really poor health outcomes historically, are kind of faced with diabetes and many are seniors living in poverty, and so TPP Capital Management Group, which is a Black-led social impact private equity group, is aiming to invest in improving these health outcomes in this particular neighborhood, starting at least in this particular neighborhood in Philadelphia. Their plan is to scale their work, but they focused on this particular neighborhood and will be investing upwards of $300 million, though their eventual raise, they hope, is upwards of $1 billion. The Center for Rural Innovation, which is to plug our previous webinar, they participated in that, in the Innovation Fund. Folks over at Corey talked a little bit more about their investment strategy and how they're investing in operating businesses. So for more detail on some of their work to date in the Opportunity Zones market, I encourage you to take a look at that previous webinar last month as well. But just as a preview, they recently invested in this company called Voy, which uses artificial intelligence to provide behavioral healthcare solutions, focusing on mental health particularly. and those at risk of suicide. They're looking at applying this to the U.S. military and veterans, but beyond as well. And we've again kind of seen some really staggering statistics from the CDC lately in light of the pandemic. Related to mental health deterioration and thoughts of suicide. And so again, this is I think a company that maybe unfortunately meeting the moment again, and Center for Rural Innovation made an investment here in this company to hopefully address some of these challenges and provide a solution here. So they are based in rural Vermont as well. So I think rural is the next one, but that's a really important thing to note as well, is that these investments are not just taking place in urban environments. We are seeing some investment to rural places as well. So I think with that may be a good segue, although I hope I'm not going out of order here. I might be, but we'll get to that as well. So I think I'll turn it over to Rachel.
That was a great segue, Catherine. And, one of the questions I get is, how do you define rural? And I think the point being, to Catherine's point, we are seeing a geographic diversity in where investment is going. And it's not just concentrated in the major metro markets. And so while, your definition of rural may be different from someone else's, we're providing 2 examples here of recent announcements, and we have many more on our website. So the first one, we were really excited to hear that Bright Energy Innovators, 2 of their portfolio companies, have received equity investment through Opportunity Zone Capital. They're startup companies. One is Entwine Connect, which is a tech company, and the other is Generator Works, which is also a tech company. And so I think it underlines this theme around, we're seeing a lot of investment into startup technology companies. I think as we look at the digital divide and the lack of access to broadband, and we try to address those problems, I think there's also been an acceleration in how we can use tech to help reach the most disadvantaged residents and help, I think tailor different learning techniques or things that can just make their life more efficient and manageable. And so I'm thinking specifically about the education technology sector and how much opportunity is there to make investments through ed tech solutions. Another example is in Ralston, Nebraska. This is a really great project. So this is the revitalization of the old Ralston granary. The mayor has said that there's been interest over the years from investors in redeveloping this property, but no one has really been willing to take a chance on it. And so now we're seeing that a group called I See It Ventures is partnering with Ralston and others to create a $114 million partnership that'll help bring new homes, businesses, and jobs to both the city, but also specifically to this site. I See It Ventures is going to invest $2 million. It's going to do that to create a business accelerator. And they're hoping that within the next 2 years, that accelerator will foster 10 new businesses, create 100 new jobs right on site there. Really notably, the president of I See It Ventures said that he specifically chose Ralston because of the OZ designation, and that the tax incentive is allowing him to increase his investment in the community by 27%. So a lot of folks ask about, what is the but for here with opportunity zones, or how is opportunity zones as a tax policy or tax benefit actually moving the needle on more investment into communities or influencing investor decision making. And I think that this is a really great example of a way in which it is doing just that. Next slide. And then for our final example, this is another great one. We're actually developing an investment profile featuring this example, but it is a 192 unit student housing project. And, a lot of people think student housing, is there really a need for that? And in some communities, there truly is a need for that. And it'll help UNC Pembroke specifically try to meet their goal of enrolling 10,000 students. Right now, I think they're right at about 7,000 students, but hitting that 10,000 student mark will help qualify them for research grants and federal funding. A lot of people don't think about that. And so this is part of the university's strategic plan, and the student housing is going to help support that. Their student body is a majority minority population. So we have some breakdowns on the demographics. 13% of students are American Indian, 31% are Black or African American, and 7% are Hispanic or Latino. So really helping to provide affordable options for those students to live adjacent to campus and expand learning opportunities for those students. The but for here is that the developer has said, or a partner on this project has said, that they've been trying to get this project, advanced multiple times over the recent years, but the organizations that typically provide financing for student housing projects really don't look at campuses under 10,000 students. So again, that benchmark around 10,000 students. And so due to the very specific nature of the financing needed, they were having problems closing the capital stack. And that's where I think the flexibility around the opportunity zones policy really comes into play. They were able to leverage OZs to close the capital stack, advance this project, and hopefully create meaningful outcomes for both the students attending as well as the university. Next slide. Great, and this is where we are going to start our Q&A portion. I know that there were a number of questions that came through. We try to answer a few of them, but I'm actually going to kick it over to Catherine to lead us off here.
Yeah, thanks. So yeah, please continue to submit any questions you have for us in the Q&A. I believe we've answered several of them, but to start off with the definition of affordable housing and workforce housing. And I know Rachel, I believe, answered this, at least in part, when going over the examples around affordable housing. But essentially, affordable housing as a general rule, I think, is ones that require additional subsidy, whereas workforce is, and I think she used the threshold of 80% AMI is kind of getting into that workforce housing, 80% AMI or above. And I think usually the 80% to 100% AMI is often where we see those kind of boundaries drawn, although it's fairly loose. But affordable, when we talk about affordable or think about affordable, and of course, that could mean slightly different definitions for different communities and their needs. But affordable housing could include like light tech, low income housing tax credits. The 60% AMI is a general threshold that's used to define projects that are eligible for that tax credit in particular. So anyway, I hope that answers your question as to the difference between affordable and workforce, and I think it really is on the spectrum. But generally, workforce does not include additional subsidies, in order to be constructed. I think one interesting question here is just kind of, great examples, but kind of where has there been either kind of disappointment or not, not a lot of further progress kind of made, in the OZ market. And I definitely open this up to Rachel and Kenan as well to answer here. My first take would be, while we are seeing the significant progress on the operating business side, we of course would have loved to see that kind of accelerate even quicker. And a lot of that was a function of the regulations and the kind of slow start that they had for particularly the operating business sector of the market. The real estate was either self-explanatory, or the initial guidance that was released kind of shortly after the law was passed helped real estate really take off, but didn't answer some of those fundamental questions around operating businesses. Luckily, now we have a lot of those questions answered, but that came a little bit later in the market's development. And so, I think we would have liked to have seen almost that inverse of it, but still are glad to see the progress that's currently being made in that sector of the market. I don't know if Ken or Rachel have other thoughts there. And in the meantime, I will look at the couple of additional questions coming through. So in terms of the next question is related to investments that were moved from somewhere else, coming from underserved areas that are now even less served. So I'm thinking that this may be related to the CEA report and the you know, the kind of movement or the shifting of capital from other places into opportunity zones versus either capital that would have already come through or new capital entirely. I don't believe that we have a good understanding, although Kenan, please chime in here on where that was moved from in terms of if those other, if they were other distressed communities or not. But I think that this pertains to the CE report's finding in that sense. So yeah, go ahead.
Yeah, thanks. It's a great question. So yeah, thanks, Kyle. We don't have any information on where it's moved from. It's just anecdotally in what we're seeing. I'd say this bucket of this bucket of capital that was quote unquote shifted should more be considered. People were planning to make an investment anyway, and they were location agnostic. They weren't really putting a second thought into exactly where or why to choose that location, and they ended up deciding to locate it in an OZ because of the incentives involved that it improved the economics of the transaction. So I think it's generally prospective, as an investment was going to be made anyway, so now it's made in an OZ instead, rather than just given some of the rules and regulations. It's hard to uplift and move over to an OZ, so take from one and give to another. So we don't have any examples of that. We have heard of some companies that were expanding and then kind of through a relocation and expansion at once went into an OZ to benefit from the investment as well. So that's kind of similar to the first model. But so far, we are not aware of, and this is mostly coming from reading the news clips and all, aware of any like real zero-sum transactions to be potentially concerned about, although it's something to definitely keep everyone's eyes open for, because that would be good to know. So.
Great, thanks. The last question that I see coming in here is related to an increase in partnerships between larger OZ funds more focused on real estate and smaller funds that have more specific projects to boost business development and community revitalization. So certainly first that comes to mind, and this maybe have prompted the question, is Launchpad and Caliber that we mentioned in Mesa, Arizona. Caliber is a larger, more real estate focused opportunity fund that had plans to revitalize areas and corridors of downtown Mesa, and found that partnership with Launchpad to occupy their space as a co-working space, but also invest in Launchpad as an operating business as well. And Launchpad has also plans to start a fund themselves too, and invest in some of the companies that are locating or co-locating in their co-working space as well. So it's a really interesting model that I think uses opportunity zones and that investment in pretty creative and innovative ways. That I think is something that we'd like to see. We'd certainly love to see that model scaled even further. And I know Launchpad certainly has hopes of doing that across the country, but we would love to see others that are working toward that goal as well. And think it's a really interesting new, or maybe not a new structure entirely, but a really important one that I think is helpful in building the entrepreneurial ecosystems. That is a really important aspect of opportunity zones, and one that was always really core to its intent, is advancing the creation of these entrepreneurial ecosystems across the country and in these places that have traditionally been overlooked in terms of investment. So the next question coming in, do you have any data about how many projects involved local funding to supplement the OZ investment? So again, Ken, I'll call on you to chime in too, but I think generally, we don't have, comprehensive data, and it is more, I think, anecdotal at this stage in terms of the capital stack and, who hasn't, if local funding has supplemented OZ investments or projects within opportunity zones. I mean, anecdotally, we have certainly seen quite a lot of examples of that. Also to Kennan's point about some of the earlier examples and the use of other tax credits that have been paired successfully with OZs, from historic tax credits to new markets to LIHTC as well. But local funding is often an important part of the capital stack too, and we've begun to see local governments can be involved in that stage as well, in providing either debt and concessionary debt and other forms of capital to help these projects kind of meet that last mile mark of their capital stack and move forward successfully. So in terms of the 2-year extension, so and this has been a priority of Senator Scott, who from South Carolina, who was the champion in Congress or in the Senate, particularly on the Republican side for OZs. He has mentioned that he wants to essentially extend that 2026 date when your capital gains would come due. So they would be reduced. If you held your investment for 5 years, you'd get a 10% reduction. If you held it for 7 years, a 15% reduction. But either way, you would still have to pay capital gains, your capital gains taxes on the initial investment by 2026. What he's hoping to do is to extend that out until I think 2028, so essentially 2 years, to allow for more time for investors to invest in the market initially and receive that step up in basis benefit, in addition to the 10-year hold benefit that comes at the kind of the back end. Great. Well, actually, we are almost out of time. So I wanted to just highlight a few opportunity zones resources too, and certainly if there's one more question that comes in, we can aim to answer those. But with the couple minutes we have left, I did just want to make sure that we pointed out some of the resources that we've developed on our site, as well as other resources that we wanted to highlight and think are really important as you look into this further. So of ours, as Rachel mentioned at the top, the OZ activity map and that was the screenshot on the previous slide, was a screenshot of that. So you can see here, this is a real cross-section of innovative and impactful projects that we have curated on this national map, and they include investments, initiatives, and funds. You can also submit information if you would like to add your fund or your investment or your local initiative onto the map for consideration. We also recently created a website that highlights investments along some of the categories that we talked about today. So again, I encourage you to take a look at that for more information, for more examples of investments across a real diversity of use cases on that site. Our OZ Resource Center generally has our kind of updated facts and figures about opportunity zones, as well as a list of both resources from us, including all of our past webinars, as well as external resources too. So in addition to the CEA report that we've been mentioning, the White House has also put out three other reports, or two other reports and one list of completed targeting actions. They've continued to look at additional ways that federal agencies can align, and that is updated, I believe, on a monthly basis or bi-monthly. And then there's a best practices report and a community toolkit, a second volume of that as well, all of which came out earlier this summer. Finally, the Milken Institute recently put out a kind of white paper report on how OZs can help accelerate a post-COVID economic resurgence. I think, kind of taking away from this is we really think that opportunity zones, and we hope that it will be a tool once we enter the recovery phase of this global health crisis and then the resulting economic disruption. We hope that OZs will be certainly an important tool in the recovery of some of these hard-hit communities. And finally, the Office of the Comptroller of the Currency recently put out a fact sheet on opportunity zones and how particularly financial institutions and banks can be involved in the incentive and its implementation. So with that, I think we are 1 minute over time, so we will wrap up. Again, this has been recorded. We will share this recording and slides and a recap of the discussion with all registrants within about a week of this date. So thank you all so much for joining. We really appreciate your thoughtful questions, and we hope you have a great rest of your week. Thanks, everyone.